Hi, this is Sean Adley with SDC, Securitization and Debt Courses. I am also the CEO and Senior Manager of Mortgage Audits Online. Today I'll be going over the Module 1 in the Emerald Advanced Securitization Audit course, where I'll be teaching you about different aspects of securitization, the securitization market, and other things relating to it. And I will be going over one of the sample report variations. I will be starting by going on the actual course link here. And since this is the first module, for those that need a brief 101, Securitization 101, I will start with this particular screen here. And basically, what you see here is a visual on securitization on how it relates to an average homeowner and an average home mortgage loan that somebody will get. As you see here, an elderly couple borrows a mortgage loan, right? You get a mortgage from a financial company. And basically what happens here, there was a huge securitization influx, back in the previous refi boom, right? Um, there was a lot of securitization going on the back end. And basically, in a nutshell, what securitization means is basically um, the loans are basically being, in a nutshell, being sold on the secondary market. And what that means is like, for example, let's say this couple here gets a loan from, let's say, Bank of Blue. I'm just going to mention fictional names for banks or lenders. Bank of Blue or Wonder Bank. Basically, that loan, in addition to a bunch of other loans, could get bundled up and sold to and put into a trust or transferred around, thus the word securitization. So that's basically what it means. In a nutshell, kind of means that it's being sold, right? And we're going to read the definition here. As you can see, securitization at the heart of the cheap credit binge was a process known as securitization, where Wall Street began to buy up subprime mortgages and package them as mortgage-backed securities to sell to investors. So there it is, selling. It's basically selling, packaging up loans and selling them in bundles, okay? Um, so you see here, it gets packaged up. You see you have a picture of a mortgage broker here basically, doing the paperwork, sending it off to the lender. In this case, it's showing you a subprime lender. Now, basically, what subprime mortgage lender means is that people with the lower end credit or mid credit, not the greatest credit, they would go to a subprime lender and get a mortgage loan. Okay, the subprime lending was big back then in the last refi boom, and I actually started in finance. I actually worked for mortgage brokers in the starting in the year around 2006. So I actually came in at the tail end of the refinance boom. And so here I am, at that time coming into the industry, and I'm basically seeing, all these people in the offices, the mortgage broker, obviously, but also the other people that were working in there, like the loan officers, the people that were processing the paperwork, but primarily the loan officers, they were making, good money. And you had these loans, these really toxic loans like the negative amortization, the pick a pay loans, and all these different adjustable rate loans, right? Well, somebody's payment would adjust after a year, 2 years, 3 years, 5 years, right? Depending, or 10 years, depending on the adjustable term. But the point is that when I first walked in into that industry, that's basically what I saw. And call centers were big back then. I noticed a lot of people having telemarketing rooms. And it was like it was just interesting to see the amount of loans that were being funded on that side, on the front end, and the amount of money some of these loan officers were making. So for any of you that is on the course, um, that will watch this, if you remember during that time, if you were actually getting a home loan, or if you had a friend, or you were buying multiple properties, remember you had a loan officer, you were dealing with them. And so, there was a lot, the industry was really growing back then as far as the mortgage brokers. And, these mortgage brokers were making, a lot of money. And there was some documentaries that actually resulted from that. What I would recommend you guys take a look at. But regardless, so you had the mortgage broker, you see this mortgage broker guy. So I basically worked for one of these guys in the beginning. So there I was, managing the office and doing my job. And so all these guys were, do funding loans and making money basically. Um, so then as you can see here, you see these large buildings, and so then these loans would be packaged up and sold. Okay, sold into securities, sold into into trusts, and basically these are hundreds or even thousands of loans. Now, when I first started in the securitization audit industry, I actually was I research was one of my jobs. So basically, I would actually go into there was a Bloomberg terminal, and I would actually on the terminal myself, and I would do research, and I would look at some of these securities, so the securitization, and I would look at the databases. So you could actually look at a database that actually has all of the loans listed there, like from one, two, three, four, five. So you go at the bottom, you have hundreds of loans in there, or even more. I mean, it was an Excel spreadsheet. You could actually extract the database. Okay. And this is part of the training that I'm giving here so that you can learn from my experience. You could actually extract the database and look at how many loans was in that particular trust. And the loan numbers, I noticed that the loan numbers would be changed, a percentage of the time. So, you would see one loan number on the client's documentation. And then when you go into the database of where the loan was sold into, where the loan was securitized into, right? The loan number would be different, I would notice. So that's an interesting note. That's something you might want to take a note of. But that was interesting. But yeah, I was actually a researcher, and I would actually go into the databases and I would do research on the securitization. I would see some of the figures on the values, in the millions, So basically, as you can see here, you kind of see the flow here. It kind of shows you the rating. So just the rating agency basically rates the securities and the bonds. So like a bond will have a rating, okay. Um, and then here you see the investors. Okay, so investors can buy into a bond, right, or a security and get dividends from their investment. Okay, that's one of the things you see. Here's a loan pool, right? So that's kind of in a nutshell what securitization is. Okay. Obviously this is a more simplified version, but this kind of gives you an idea of what is going on. Okay. Now this graph here, it shows you, okay, like kind of like in a flowing style. You see the mortgage loans, right? The path of the mortgage loans. Okay. You see the certificates being offered. You see the underwriter here and the investors. Okay. So you see cash, cash. Obviously, cash is king. But this kind of gives you an idea of what's going on. Okay. And here, and by the way, this kit obviously is included with the Emerald course. You can go in here. This kit is offered regardless, but this obviously the Emerald courses, we go more in depth and you get to learn a little more, and I go more in detail and kind of going off the kit as well as a starting point to go into my experience and what I have learned being in this industry for so long. And so this particular graph here, this is an interesting one as well. Follow the mortgage. It says what happens to your mortgage, after you sign on the dotted line. Okay. So this is borrower, broker, lender, investment bank, and investors. Okay, so it's kind of like what I mentioned before as well there. Okay. Here it's showing you a flow chart, okay, of securitization. Okay. So here it's giving you a little more, some other terms that you might want to look into. And you'll also get a definition sheet with the course that will actually show you the definitions. I'd recommend taking a look at that as well. But as you can see here, you have the lender, seller, you have the initiates the securitization. Okay, you see here the lender, seller delivers loans to the trustee. Obviously, the trustee is an important part of this. And then you have a custodian. Okay. These are kind of more like, record keepers. As you can see, the custodian performs the initial interim certification. Okay. Custodial performs final certification. Custodian retains the loan file. So it's kind of like record keeping. So the custodian is more of a record keeper. Just keep that in mind. And you see here, recording offices, what that means obviously is the county. Okay, the county recording offices or where the property is located, perhaps even the city. So what happens is there's these documents called the assignments, right? So the assignment of mortgage is a document that they will file when the loan has been sold, transferred, or securitized, okay? So that document, unfortunately, the homeowner is not really notified that this document is being filed. I mean, there's nothing really illegal about that. However, you can check yourself. Like for me, being in this industry over 10 years nearly, I noticed that, sometimes homeowners would not be aware that there was a document called the assignment of mortgage or corporate assignment of mortgage, it's also called, until we actually ran a title search. And so a preliminary title search. And then I would see that there was like an assignment filed, an assignment of mortgage or multiple. And then I would pull them and say, did you, Mr. and Mrs. Homeowner, did you know of this assignment? And they were like, they said, no, they did not. So that's an interesting point. And I'd recommend you also do a title search on your own property and see if there's any assignments in the past. You can actually do a title search yourself. We also can do it through our company, the mortgage audits online. We can also assist you with that as well if you need help. But really, I've seen files where, there's over 10 assignments. I mean, I've seen files that there's 5, 6, 7, 8, 9, 10, 11, around those figures, but even more than 10. I believe there was one file that had about 14 or more assignments. So, that could indicate that, the loan was sold many times, it was transferred. Sometimes they're trying to correct something. So you'll see something called the corrective assignment of mortgage. So there's correcting something or some mistake. But yeah, I've actually seen that in my career. Um, so as you can see here, the assignments are then filed with the county. And then, this is the flow of it. And, here's the lender seller. So, again, a flow of securitization here that you can take a look at. This is more of a modified CMBS flow, post securitization, normal servicing. Okay. This one is actually when MERS is involved. Okay. So you see the borrower here sending the payments. Okay. And you see how MERS is involved here, okay? Um, Now, this is interesting because this particular one actually shows you that in this particular section here, you will see under the terms of the PSA, which is the pooling and service agreement, certain circumstances may require the special servicer to approve actions or perform duties. So this is saying that inside of the prospectus, the pooling and service agreement, sorry, there is a section where when you go in there, and the pooling and service agreement, the prospectus is the document of the securitization trust. Okay. It's a very long document. Some of it can be about 300 pages long. And there are sections that govern the securitization, the rules, the guidelines, those type of things. And we'll go over one in the later modules. However, that's something that you can go into. For example, if you have a securitization report, right? Like you ordered a securitization report, you have links to the prospectus in there. So then you can actually go click on it, download the prospectus, okay? And then you can actually go through the prospectus and find out the different aspects of the rules or the guidelines. As you can see here, there looks like there's a rule here about the PSA, requiring the special servicer to approve actions or perform duties, okay? So that's, in a sense, gives you an idea of, what the pooling and service agreement, along with there's a lot of other information that goes in there as well, but that's what gives you a small little a snippet of an example of what that's for there. And here you see the custodian and the trustee mentioned here and the investor. And then MERS is involved. Okay, now this is interesting because you see here lien releases in the name of MERS. So, for those of you who have MERS on your documentation, and we'll go over this in a later module, but you definitely want to read your loan, the note or the deed of trust or the deed or the security deed a little closer, because you'll notice in there verbiage relating to MERS and how MERS is relating to lien, or how MERS can possibly foreclose, or how it's related to enforcement of the lien, or can file a foreclosure. So I would recommend those of you who notice a MIN number, an MIN number on your document, okay, that means that MERS is involved to some capacity, as you can see here. To go and look closely in that paragraph where it could be multiple paragraphs where MERS is mentioned. To go to those sections and read carefully how MERS relates to your loan, because it's very important. Because there's a section in this kit that actually is a MERS manual, and it will give you a very important piece of information. Which we'll go into on a later module that relates to MERS. So just keep that in mind for now. And just a few other things here mentioning, you will see master servicer deactivates loan on the MERS system. So, some of you that know how to look up the MERS MIN number. Okay, if you don't, we will go over this in this course. However, not this minute, later on. However, when you go on the MERS website, you can actually enter the MIN number on your note or your deed of trust or your documents in the system. And you will notice on there that it will say either active or inactive on the right-hand side, usually. So, that's something that you want to note, because as you can see here, it says master servicer deactivates loan on the MERS system. Okay. So that's something that, you need to keep in mind. So the master servicer is, the servicer that relates to the loan. Okay. It's a master servicer. So keep that in mind as well. Okay. And then on the right-hand side here, you'll see master or primary servicer updates MERS system to reflect data changes. So this also is another good piece of information. And the other thing is, on MERS, you can actually look up the investor of your loan, which we will go later in a later module. So yeah, this is this is basically, so these are, again, there's just in closing here showing the flowing of the actual securitization in different aspects of these particular flow charts and guide here. But definitely would recommend, with this kit here that you will also receive, to go over this and read through this in detail. But I've given you, a good overview of it in this particular module. However, it is a good idea to kind of go through it on your own and read through it a little more in detail, and also watch this video at the end here. But that kind of gives you an idea of what securitization, is in a nutshell. So, again, they're taking the loans on the front end, okay? Let's say Wonder Bank, fictional bank again, funds, let's say 100 loans in 1 month, right? 100 mortgage loans, or auto loans, or credit loans, okay? Credit card debt, or auto loans. So let's say there's 100, mortgage loans. Those 100 loans will be divided up. Let's say 25 goes into one particular securitization trust. The next 25 will go into a different trust, and so on. And the reason for this is because certain trusts will have certain metrics on what will be securitized into a certain trust. Like there might be, let's say, fictional name, Wonder Trust Securitization AMBGS-2010 AB will be the name of a securitization trust. That's kind of how their name kind of flows in that way. Let's say that particular trust only securitizes loans between $250,000 and $750,000 with a certain credit rating. Okay. So in the prospectus of that trust, you'll notice that it's only, or it's primarily securitizing loans of a certain guideline, of a certain metric. Okay, where it only wants these loans. Okay, these loans that are between $250,000 and $750,000 loan balance, and who has a, let's say, a 700 credit score. It's just some metrics, for example. So those loans will be securitized into that trust. Okay. And there might be another trust, another trust name, let's say Wonder Bank 24-B SD 23-5. So that one will securitize all loans within, let's say, March, April, May, under $250,000. So all the loans under $250,000 will be securitized into that trust based on the metrics. Okay. Again, it's not exact. I mean, there could be some deviation, but however, that gives you an idea of okay, these if my loan is 258,000, it's going to be in this trust. However, if my loan is $150,000 loan balance, it's going to be in this trust over here, the A, B, the one I just mentioned. So that gives you an idea of how they securitize. Okay. Now, that's how it's divided up. Okay. You know, it's going to be multiple trusts. Okay. For like a bank. I mean, not meaning that your loan is in a multiple trust, but multiple trusts where they're securitizing certain loans into certain trusts, right? So, and based on certain guidelines. So that's kind of what you will see on in the securitization, as far as the front end goes. Now, the securitization market is a really big market. There is a lot of interest made, the values. I was doing a presentation a while back on one of the bonds, and the bond was worth about $20 million, and the value influxed over the year. So, we're talking millions of dollars here, dividends, interest. So, there is a secondary market, there is a securitization market, obviously Wall Street is involved in this. And basically, what they're doing is they're selling our loans. And they're selling our loans, and they're making money off of it. And that's basically what it is. It comes down to profits, it comes down to money. I mean, look, when you deposit your money in the bank, I mean, obviously the banking system is lending the money out, right? So that's how the banking system profits, right? That is the banking system model. Okay, the business model of a bank, okay, is to lend money, right? So, for example, you have a bank. Let's say I open up a bank, for example, fictional. Okay, let's say John opens up a bank. John opens up a bank, has let's say $100,000 cash reserves. Okay, so again, this is an estimate, but this is for conversation's sake, educational sake. The banking system, once licensed and they meet the requirements, that $100,000 in John's bank now can be leveraged, right? So the leveraging that you are seeing, you know, 5x, 10x, whatever it is, that is how the banking business model is. So the $100,000 in reserves. Now, John's bank can lend out, 5 times, 10 times that. So like imagine 5 times that, what is that? $500,000, right? So they can sit down and obviously through the proper venues and the proper compliance, write up a note, right, and lend on this particular person's house here, right, in this picture. So 250, here's $250,000. Here's the loan, and we're using your house as collateral, but we only have $100,000 reserve. I mean, that's just how the banking system works in a nutshell. Okay. Now this particular loan that was just written based on fractional lending. Okay, now this $250,000 loan is being sold into a securitization trust, bundled up with maybe 10 or 20, 30, 40, who knows, 100 other loans, and bundled up and then sold, sold into a securitization trust, put into a securitization trust. Okay, placed in there. Now interest is being made. Now there is dividends, right? Now there's investors investing into that securitization trust. So there's money in the front end, there's money in the back end, and obviously the secondary market on the back end, it's millions of dollars. Okay, I remember in my career early on when I was working in the for the mortgage brokers. Um, it was briefly mentioned in a little casual meeting we had with some of the representatives from one of the lenders. The lenders, the wholesale lenders, or the lenders, the account executives for the banks would come in, lenders and banks and wholesale lenders would come into our offices and leave flyers with rate sheets and the kind of wholesale rates that they could provide, in case in case someone in the office wanted to send a loan to them, right, as a broker, because a broker was going to shop your loan around. So there was a casual meeting, and I remember somebody briefly mentioned something where they were like, "Oh, these loans are sold on the back end, right?" So then, it's not something that is really publicly announced. It's something that it's kind of like, when you go into a store, obviously you're buying something retail, you obviously don't know where the store is buying it wholesale. Obviously, they have a wholesale source. So it's kind of in those terms. And I remember speaking to somebody years ago about, there was a room inside, I believe it was a bank or a lender, and in that room, there was a couple guys working in there with some software terminals, and they were bundling up loans. So they would have another department bring them the loan files, and then their job was to look at it or input it in the system, bundle it up, and then list it for sale to other banks or securitization trusts in that regard. So literally their job in that room was bundling up loans and selling them, and there was a software platform that they were using. So that's just to give you an example from my experience, what I've seen and heard in my career over the years. But yeah, I mean, securitization was huge back then. I mean, it's still big. Obviously, in the last refi boom, back then in the 2006 era, and then it started to crash in 2008 and around that time, and a little shortly after, when New Century, one of the big lenders back then, which were doing a lot of loans, they went out of business. That was kind of the early stages, I believe, of that crash. But you know, it's obviously a multi-dimensional, multi-issue because you had back then they were pretty much giving loans to pretty much anybody in a sense. I mean, even the subprime lending was big back then. So if you had really bad credit or if you had not so great credit, you could still get a mortgage loan. And so, basically, in a sense, they were one aspect of it, they were giving loans to people who technically couldn't really repay it in the long term, on paper. So that's one of the things. So back then they were, bundling a lot of loans. And, from the underwriter's perspective, you have underwriters that are underwriting the loans, okay? And the underwriter's job in the bank is to ensure that these particular loans meet certain criteria. So, there's another issue where, and I respect and underwriters as well, but from what I've heard from underwriters is that there was pressure on them to get the loans funded because, as a bank or lender or wholesale lender, you have a reputation. And if people are not getting their loans funded, or if you're not meeting your quotas for the month for funding, obviously, we have to sit back sometimes and think, well, these banks and lenders, it's a business. That's one of the things that some people don't realize. Lending money is a business. So a bank is a business. Okay, so in a sense, the underwriters to some extent were pressured to some extent to get these loans funded. So it's a multilateral issue. So you had all these loans being funded, and rapid rates, huge numbers, huge funding metrics, and then these loans would then subprime loans, for example, were then securitized and sold on the secondary market. We all know what happened to some of the lenders like New Century, Countrywide. I'd recommend Googling just and reading about Countrywide home loans and seeing what happened with them eventually. But yeah, that is the initial of this first module here. The next video will be going over the sample report and some other things relating to securitization. Okay, thank you so much.